to the latest PCD members session. Every Wednesday at 2, we're broadcasting, bringing you the latest topics for private wealth advisors from all around the globe. We feature our members in these sessions, and we try and bring our audience a showcase of the best insight we can get on a variety of topics. We have two audiences with us today, an audience of PCD members here with us on Zoom. Welcome to you. But also we have a broader audience joining us live on YouTube. Welcome to you. After we'll run this discussion on risk for trustees over the course of the next 50 minutes, then we will cut the feed to YouTube and finish off the session with a little bit of networking with our PCD members and our panel conducting a live Q&A. So we've got a great hour ahead planned. We're going to cover a whole variety of topics that are relevant for the fiduciary sector, but also the other sectors of advisors that interact with the international and offshore trust world. So lots to discuss in the world, in the field of insurance, in tax, in investment, litigation and disputes. We're going to bring in our expert panel shortly. As always with PCD, we'd love to hear from our members. Let us know where you're watching from. Let us know any questions, and I'll bring those points up live to our panel as we roll through. So do put your questions in the chat, and I'll bring them on and hold our panelists to their mettle for the answers that you desire. So we're going to kick off with the discussion now, and I'm going to start off looking at the insurance sector. So Charles Hamilton-Stubber, welcome, Charles.
Oh, thank you very much, Dave. Welcome everybody.
So we had a great session back in January on looking specifically at luxury assets, but perhaps you could give us a sense today, as we're looking at risk for trustees, what are the key areas that trustees should be doing to mitigate risk on assets they're responsible for?
Yeah. Thanks, David. I think there are really there's sort of two areas of exposure that trustees face, and one area is the actual assets they're looking after. And the other area might be their potential liability as being a trustee looking after those assets. So if I covered off very first the liability issue, which really boils down to the trust itself and the trustees having very, very good governance in place. And this would be around, having trustee meetings recorded, stored securely, and having dual controls on the financials, and all the fund transfer procedures and investments, and that's good governance for a trust. And if the trust is primarily property and buildings, obviously those buildings have to be insured for their liability and their property. And also, is there a third-party property management service looking after those properties? I mean, many insurers will probably insist that there is a third-party manager rather than the trustees doing it themselves. And, for instance, where you're selling or buying property, is that surveyor being appointed by or a member of the Royal Institute of Chartered Surveyors? They just look at the sort of generally good governance. And most trusts and trustees are following these procedures, definitely. If it's again with financial, with equities, bonds, again, a third-party manager. And does a written agreement exist between the trust and those third-party managers? That's also very important. That's what they look at. And the last, there are other obviously types of assets, but if I was to take one last section of sort of antiques, fine art and valuables, that would be more, David, where you're looking to make sure that they're all properly valued and there's appraisals done. Probably the insurance market would expect every sort of 5 years-ish on making sure that the valuation's in a place. And it's just really a sort of a duty of care of the trustees on behalf of the beneficiaries to make sure that that's also properly insured and that the valuations are done. So just to, in brief, though that should mitigate some of the exposure or most of the exposure to make it slightly more correct for insurers to have a look at.
Okay, thank you. And what might stop an insurer from insuring a trust?
I think that probably, I mentioned it briefly, but the fact that nothing is third-party managed, that they would expect that to be third-party managed. I think they would also look at, if there was a relatively constant change in management or constant change in the investments of the trust, they would sort of go, whoa, they'll have a closer look at that. And also a turnover of trustees wouldn't fill them with great confidence. So those are the sort of main areas of where an insurer might look at more carefully or not look at a particular trust or trustee.
Okay, and I mean, what sort of incidents have insurers been aware of that could have resulted a claim against the trustees of their personal kind of risk management?
Yeah, I think sort of missing key deadlines. I was given a couple of examples by an insurer where late filing of accounts and statutory requirements, obviously disgruntled beneficiaries, where a trust may not have been administered in their best interests, and one could say that trustees could be covered by their exoneration clauses if that's been written into the trust deeds. But we're seeing that, and other members of the panel might be able to expand on this. But there's an issue that this clauses, they're not uniform and they can still cause consternation. And even if they are valid, the trustee is going to have to defend the claim. So you're still going to have to employ a specialist trustee lawyer. So those are the sort of instances where we've seen, insurers have seen where there are some disputes or incidents.
Okay, thanks. And we'll bring Tom in on that point later on. But I mean, into looking at specific assets, are there any certain assets that are, more difficult to cover, unattractive for the trustee to?
I think that probably that it's the style of investment that they'll be looking at. I think probably we had one incident where land actually cropped up as a trickier one because there was some mineral rights they found out about, and that would have had to have been dealt with by a third party, obviously. And you might find that with a third party involved, this might put underwriters off to looking at that type of asset if something like minerals were found and were to be extracted. So that was just one example of where they might have a little bit more of an in-depth look at the investment side of it.
Okay, and what about a trust obtaining cover for people, retired trustees? If these decisions are being made, there's a tail to the impact of those decisions. How does that get covered?
It's something which underwriters do look at nowadays, where they're looking at, say, you might have a situation where from one year to the next, a trustee might wish to retire, and therefore, as long as the policy is kept in place, then there could be a retroactive date which you can continue to cover that retired trustee. That it could be negotiated at the time, and there may be a small additional premium. But there's no specific exclusion for professional trustees. This sort of liability issue is very much for lay trustees because they might not have the cover that a professional trustee might enjoy under their firm's cover. So underwriters will look at retired trustees. And if there has been absolutely no change in the trustees over many years, they may well do a retroactive date as long as the policy continues to run forward.
Okay, terrific. Well, look, thanks for kicking off the conversation with us, Charles. Going to move on to Dawn to look on some tax and transparency issues. Welcome, Dawn.
Hi, David. Welcome, everybody. Good to be here.
Thanks a lot. So, global tax transparency initiatives well ingrained now in the professional sphere, in the private wealth sector. We've gone through the compliance phase. Now it's into how tax authorities are using data that's been gleaned out of those from those initiatives. Perhaps you could bring us up to date with where we stand on that.
Yeah, very much so. I think don't want to use too many three-letter and acronyms, but we've had CRS, so the Common Reporting Standard, for many years now, or certainly it feels like we've been talking about it for ages. But I think, as you say, what we're seeing now is tax authorities who've had at least 2 years of data. So certainly most mature tax authorities who signed up to the first and second phases have had data exchanged since 2018. And clearly that's taken some time to then filter through into their compliance inquiry and investigation processes. But we are certainly now seeing that in practice. And in the UK, I would say that's very much in full swing. Just before the pandemic, there was a short pause, March last year, but actually, you know, some people may be aware that HMRC continued to write out to individuals, largely private clients and trustees, which is why it's so relevant to this audience, from August 2020. So they send monthly batches using the CRS data where they perceive some kind of mismatch with the data that they already hold.
Is HMRC putting a lot of resources into this area? I mean, is it sort of driven by artificial intelligence, by case officers? I mean, what do you observe of how the revenue are tooling up for this area, you know?
Yeah, I think they are more sophisticated than a lot of people give them credit for, actually, is my experience. So, and I can only talk about the practical cases that I work, but certainly the inspectors will say that these are risk and intelligence files that they receive. Many of you will be familiar with the Connect computer system that's been around for many years. So it's HMRC's analytical tool. It becomes more sophisticated with, as you say, artificial intelligence. They have more data feeding into it, and a very good example of that is the UK Trust Register, which I'm sure is highly relevant to this audience. And so the opportunity to then automatically cross-check data, particularly with making tax digital. So most people now file tax returns electronically. There is less and less manual input of data. That then will give them a mismatch. Now, that doesn't mean there's necessarily something wrong, but that then does give a whole caseload of files for an inspector to write out to. And so, you know, people in the old days used to say, oh, Dawn, this is so random and it's a fishing expedition. And it's like, well, it's not a fishing expedition. I'm sorry. It is data led. Now, the data may be wrong, or there may not be a tax problem, or there may be another explanation. But I'm afraid the old-fashioned, you know, dismissal of a fishing expedition is probably not true in today's world. I'm happy to debate that.
No, absolutely. I mean, and our very sophisticated ultra-high net worth clients with assets and investments in a variety of jurisdictions, like analysing how this data flows between jurisdictions, or are they more accepting that this happened? How do they respond to it? Do they? I suppose it depends client by client, but what's your experience of how they analyse what sets of data are flowing?
Yeah, I mean, we have seen some very clear examples of where it's just they don't understand the data, or actually I have to say the data is wrong. And if you can demonstrate that, then the matter's closed. And I've certainly had several examples of that in the last 6 months. One to a beneficiary living in the UK, where unfortunately the financial institution had just provided the wrong data through the system to HMRC. HMRC had written a letter. We were then able to verify that the data was incorrect, and the matter was resolved. So the point is, they will walk away if you can demonstrate that. I mean, obviously other cases, they do actually highlight a problem that needs to be resolved, and so that's how they justify that process. But certainly it's very mature, it's happening in practice. They don't have the resource to follow up on every single case. I think that's true, and apparently 1 in 10 people living in the UK have an overseas asset, so they're not going to write out to 10% of the population. Clearly they are going to pick the wealthiest. I mean, I think that strategy is well known, and I don't think HMRC would deny that strategy.
Okay, and as we've established, there's more and more information being passed between various parties, and also different parties to trust structures have the right to access information about trust assets. So how are you seeing powers to access information being used by various parties?
Yeah, I think increasingly one thing CRS has done is it has joined up global tax authorities like never before. So, you know, it may be that for example, HMRC doesn't necessarily need to go to the taxpayer or the trustee. They can just go directly to another tax authority, and certainly the Joint Intelligence Committee, I think, is well known. So, for example, the cooperation between the UK and Australia is very well known. The UK and America is very well known, very mature. They will work joint projects together. And then if they want to access information from taxpayers, that's very easy through formal information notices. And now you could say, unfortunately, or fortunately, whatever your viewpoint is, there is a new information power coming into force this year called financial institution notices, which, if you read the tax and trade press, has been covered. And I think this is something particularly that trustees should be aware of, because it could lead to a direct notice to them that cannot be appealed for access to information. And again, a lot of these formal powers do override things like privacy law, data protection. So it's just something that has to be dealt with.
So trustees will have already started seeing some of these notices, or that's kind of in the pipeline and they've got to look at how they respond?
Yeah, that's in the pipeline. So it's due to whenever the finance bill receives royal assent this year, which I don't quite know when that's going to be. June or July is usually the timetable. That will come in. So it's something to watch this space for later this year and in the future.
Okay, and on another tack, Dawn, I mean, ESG and sustainable investment for trustees is a huge topic at the moment. And I mean, how do you see the tax piece fitting into that discussion that families are having about the way that their family, the values of their family and their reputation? How do you see that interplay?
Yeah, it's interesting because a lot of people obviously look at it from a forward-looking point of view, which is we want to have a very clear policy around what we will do and what we won't do. But actually, a lot of people who come to me see it as being a good citizen, and actually they do want to pay the right amount of tax. And actually, if you ask most tax authorities, that's all they want as well. So interesting, ESG aligns, I think, many good citizens with the tax authority. We just want to pay the right amount of tax. And where, for example, and sometimes we see this, maybe in a case where a new trustee comes on board, or for example, next generation of the family take over. If there has been a mistake, and it often is a technical mistake or some kind of grey area that they just want to resolve under the ESG banner, they're actually willing to make, for example, a voluntary disclosure to a tax authority to say, look, this might have been wrong, or we're not sure, we want to put this right. And they kind of actually, I think more and more that will be done under an ESG kind of governance, good governance, wanting to be a good citizen banner.
And exactly, it's about making decisions, isn't it? And if there's a marginal tax saving somewhere, they might decide actually not to go for something convoluted, but go and just pay the tax. And because the reputation piece and the decision making is the bigger picture, isn't it?
Yeah, absolutely. And dare I say it, intrusion from a tax authority is most people want to avoid. So rather than necessarily pay the minimal amount of tax possible, as you say, they may take the view that they're willing to contribute more for social reasons rather than necessarily the letter of the law.
And when you're working with trustees on UK tax matters that you're clearing up where something's been identified, or you're undertaking a review to work with the trustee to make sure everything's as it should be, what are some of the key things you're talking to people about at the moment? What do you see coming up that's a bit of a recurring trend or theme that this audience should be aware of?
Yeah, I think, again, sorry, back to the three-letter and acronyms. We love them in tax. So we had this period called the requirement to correct, the RTC, where actually a lot of trustees, I think it was quite interesting for HMRC, it was mainly trustees that made disclosures in that process. That's now ended. So actually, we're in a more serious period of failure to correct now. So if errors are found, the penalties are likely to be more severe. The way to deal with that is to come forward voluntarily, because that is definitely the best approach. Not just me professionally saying that. It means, you know, HMRC will be certainly more benign in their approach, but also most importantly, it minimises the financial penalties. So that failure to correct. And in terms of the actual issues, I mean, we see all sorts of things, a lot of technical issues, things like accidental remittances, you know, UK source income in a portfolio where actually it was large and complex and no one quite realised. Something that I think is going to be a bit of a hot topic coming out of the pandemic is where people may have changed their residency status because they have been stuck in a country somewhere. So, and then obviously in the UK, they are not being sympathetic about exceptional circumstances unless you're in the medical profession in 2021. So, you know, you could have accidentally ended up UK resident for 2021, or you could have gone abroad and been stuck somewhere and changed your residency status. So I think that's a risk for trustees to check residency of beneficiaries.
Okay. Very interesting. Well, thank you, Dawn, for that. We'll bring you back in if there's any questions from the floor. Do get any questions in for Charles or for Dawn from anything they've said, and I'll bring them back in. But otherwise, we'll move on to Paul Nixon, CEO of LGT Vestra US in London. Good afternoon, Paul.
David, thanks for having me today.
Pleasure. So, you know, looking at the investment piece, you know, trustees under pressure to make sure that trust assets are there for the long term, but also in some cases generate the income required by beneficiaries. Trustees, as owners of those assets, are under pressure to make sure they're properly managed. They consider the risk profile of that's suitable for the structure. I mean, how do you typically work with trustees on the liquid financial assets to make sure that these goals are met?
A good question. I mean, I think firstly, the role of any wealth management firm is to understand the trustee's desired outcome and provide an impartial view as to the viability of it. You know, quite often you see this conflict between the current generation want as much income as possible, whilst future generation want as many gains as possible. And unfortunately, we're yet to find that low risk, high income, high return portfolio that guarantees to meet all of those objectives without breaching any of them. So it takes a bit of understanding. And I think, you know, all families are different, and everyone on this call is very familiar with the human complexities of the private client world. In addition to the tax side, the insurance side, the regulatory side, you've also got people. And dealing with people is possibly the more complex element of that, because they don't have to be logical or rational. They just have to do what they want to do. And as a consequence, what we look to do is work with trustees at the outset of the relationship to identify the objectives of the portfolio, the known costs, expected withdrawals, and what the objective for the lifetime of the trust is. We then look to carry out a sustainability analysis. And what I mean by that is to effectively run multiple iterations of the trust with different levels of risk, different levels of return, and look at the number of different potential outcomes there can be to identify the lowest level of risk at which we can achieve those trust objectives. And then from there, we can have a more educated, informed discussion with the trustees about what the pros and cons of increasing or reducing risk from that point are. So it can become a lot more of a fact-based discussion rather than a high risk is risky and low risk is not risky. It's more about what are you trying to achieve? This is kind of where we think you should start. If you take a bit more risk, it might be a bit more volatile, but actually in the longer term, it could be worth more. However, if you take a bit less risk, that also may, given where fixed income is at the moment, less risk doesn't necessarily mean more income. So it's about understanding what the trust's trying to achieve, providing that sustainability analysis to understand, is the trust going to last as long as you want it to if we do this? And if so, then how do we eke out the additional efficiencies through the investment structure?
And how do you look at currencies in that mix? I mean, you might have a trust with beneficiaries in different spending different currencies, or assets and liabilities in different currencies. Is it about working with the trustee to agree benchmarks and yardsticks on how you do it? I mean, how does the currency overlay work when you're constructing?
Absolutely. I mean, it's the global FX market is one of the largest markets in the world. And you see the impact it has on business on a daily basis. So it's always very important to understand from the trustees what currency those liabilities are in. You know, it's fairly common for us, as you mentioned earlier, we have a US connection. So we are FCA registered, we're SEC registered. We're quite often dealing with truly international people that may have some connection to the US, some connection to the UK or elsewhere. So it's very common for us to be dealing with dollar and at least another currency. And so for us, it's about understanding where are the liabilities, what currency are those liabilities in, and what's the timeframes for them. Because obviously the timeframe you have between inception and the date of the liability impacts on the amount of risk, FX or market, that you can afford to take in order to deliver that liability matching.
Okay, terrific. And yeah, I mean, that your ability to look after US connected people is a great asset when working with the fiduciary sector. I mean, perhaps you could explain a little bit about how you work with trustees and how US people might find their way into a structure even, and create a problem if it's not properly addressed.
Yeah, I mean, as I mentioned, we have a truly international outlook, but we tend to have some kind of nexus to the US. We manage both US domestic trusts and we manage international trusts with US beneficiaries. And I think it's fair to say that over the last 10 years, everyone will have seen the greater frequency that the larger and wealthier the family, the greater the chance that at some point that trust is going to have a US connection. Whether it's one of the children or grandchildren goes off to university in the US and then doesn't leave is a fairly common one. Whether it's marrying a US person, whether it's having a child with a US person, you know, there's all these different permutations and combinations as to how a trust can end up having a US connection. And I think it's probably worth taking a step back and talking about the two particular types of trust that we really tend to get involved with dealing with. And that's a foreign grantor trust, which is a non-US domestic trust settled by a US person. So basically, you're talking about a trust set up by a US person that isn't in the US, and the settler is going to be liable for all income and gains as they arise. But the case that's probably more relevant to the majority of this audience would be a foreign non-grantor trust. The clue's in the title, it's not a grantor trust. So the settler has either passed away or is a non-US person. And quite often these trusts will have a range of beneficiaries, at least one of whom will become a US person. And the main issue is triggered when one of the beneficiaries is either receiving benefits or has benefits attributed to them. And, you know, not wanting to let Dawn run away with the acronyms, you know, anyone in this space is more than familiar with probably the most common are UNI, DNI, and PFIX. Quite often we see that trustees are very familiar with UNI, so undistributed net income, DNI, distributed net income, and therefore they've taken that into consideration at the end of the year. They make sure sufficient income is distributed. What sometimes gets missed is people looking at that next layer down as to how was that income generated? You know, how in the portfolio were these returns generated? And that's where the dreaded PFIC comes into effect. For those of you that aren't familiar with PFICs, they're passive foreign investment companies. And if I was going to do a very brief investing 101 for US connected trusts, probably point 1 or 2 would be don't buy PFICs. Very simplistically, they tend to be non-US collective or pooled investment vehicles. And so I won't go into too much detail on it, but it's a good rule of thumb. If you've got some in your trust, you should probably get them reviewed. In addition, you know, we are specialists in the space, so we know how to structure the investments, but We're also aware of the requirements to file forms like the 3528. And yet, whilst we're neither lawyers nor accountants, if this is the space you work in, you get aware of the red flags and when to bring in the relevant experts. I mean, from a US perspective, one of the main issues is obviously avoiding PFICs. But it's quite interesting that when you get to that foreign non-grantor stage, well, what we see surprising amounts of time is where you've got mixed beneficiaries, or it may be a UK trust with mixed beneficiaries, in people's desire to avoid the dreaded PFICs and adhere to the US rules and regulations, they'll inadvertently end up buying UK non-reporting funds and creating UK issues because they're so concerned about the US issues. So it's effectively about taking these two sets of rules, working with them, identifying those investments that aren't going to cause issues, and implementing it. And one of the big issues is that, as we know in the private client space, people have favorites. Every family has their favorite investment fund or their favorite investment manager. Nothing else in the world could possibly ever be as good as this solution. So the number of conversations we have with people is that may be the case, but this is going to be your increased tax cost as a result of buying a PFIC in a trust. This is going to be your increased compliance cost. This is going to be your increased reporting cost. You need to learn to look at these investments from a net benefit rather than, yes, it may have given you a great return, but by the time if you've paid away all of these other issues, it may not be quite what you're expecting to receive at the end of the day. And so we quite often get involved with, not necessarily at the start of a trust, but when a trustee inherits a trust, to do that backwards looking review, to identify the PFICs, to identify the UK non-reporting funds, and basically to provide a little bit of an introduction where necessary to the relevant counterparties, but also to act as a brake, because the immediate reaction might be, oh, it's full of PFICs, I've heard they're bad, let's sell them. That's probably not the best outcome for the settler or the beneficiaries. So it's about kind of taking the right advice at the right time and making sure that, the planning that you're putting in place remains fit for purpose. So yes, there's a US angle, or yes, there's a UK angle, but it's the same as everything where, you put in place a structure, you maintain your adherence to it, and you continually monitor it. And I guess one of the areas where the US connection can be slightly more complicated is the utilization of executive orders. And for instance, back in January, we had the US government pass an executive order that no US person could buy certain Chinese companies because of their association with the Chinese military. So that meant that from that point onwards, no one could buy these companies either individually or as part of a fund or an ETF or any other kind of structure. So having that ability to put a block on trading barred assets and knowing that you have to remove all of those assets from client portfolios by November 8th is just that additional bit of knowledge that may be overlooked by people that aren't dealing with the US on a day-to-day basis.
Okay, well, thank you for that, Paul. Very, very interesting. And finally, sustainability, sustainable investments. You can't escape it in the fiduciary sector, I think, right now. Very much flavour of the month. But I mean, how do you cater to that client need out of LGT Vestra? What's your strategy on sustainable portfolios?
Well, I think it's safe to say sustainable investing has been growing in importance for many years, and whether it's as a means to encourage the desired change we want to see in the world through investments, or more recently, it's been a significantly demand-driven change within the wealth management industry. The cynic in you could say that actually some of it is kind of, is it correctly labeled, just calling an ETF a green ETF? It comes down to the definitions. And if I'm honest, one of my bugbears with this resurgence trend, which I have to say I'm very much in favor of, is terminology. You've got ESG, green, ethical, sustainable, impact, which all are completely different things, but yet are used interchangeably. And so this goes back to, once again, understanding what does the trustee mean by sustainable? And if it is a truly sustainable definition, then actually, I think the days of saying you can either have a sustainable portfolio or a performance portfolio, you can't have both, are gone. I think, now you can certainly have a sustainable portfolio that meets those requirements. And coming back to the definitions, if someone's after a sustainable portfolio, we put together sustainable portfolios that are full of blue chip equities, green bonds, fully liquid. The trustees would be more than familiar with all of the names in there. They just happen to be companies that actually, as well as having an investment proposition, have sustainable credentials. Now, at the other end of the spectrum, if someone says they're interested in impact investing, and they mean true impact, that can often be investing in 20 unlisted private companies around the world, which are opaque for reporting purposes, they're completely illiquid, and they are truly high risk. So it comes back to the definition of what do you mean, and understanding what you're trying to achieve. I mean, over the past few years, we've spent a lot of time and effort developing a sustainable offering. We've always had an ethical offering, and the ethical offering was more traditionally based on a negative screening process. I don't want tobacco, I don't want pharmaceuticals, I don't want oil and gas. You would exclude companies from certain sectors rather than including companies for positive attributes. So to me, it's a move towards positive screening rather than negative screening. And any of the companies that we include within our sustainable portfolios have already passed the LGT screening process with regards to these are good companies to invest in. So we start with that universe, and then from there, we screen it further into which of those companies provide a good return for shareholders, i.e. the investors, and which have sustainable business models. So we're taking the approved investment universe that we would invest in for anyone, and then narrowing it down into those companies that we think provide the return as well as the sustainable business model. So the trustees should take comfort from the fact that within all of these companies, we're focusing on things like competitive analysis, barriers to entry, financial strength, management behavior, and sustainable assessment. So looking at a combination of ESG and impact scores as referenced against the UN Sustainable Development Goals. And so when we report back to the trustees, what we show them is why is each position included? Why have we held that company in there? What UN Sustainable Development Goals does it marry up with? And what percentage of its revenue is generated from these sustainable activities? So for someone that's truly interested in it, they get a snapshot per company as to why each of them is included. And so I think actually, for going back to your initial question, if a trustee is after a sustainable portfolio, that should no longer really be a scary concept for them. It's about understanding, is it sustainable you want? Is it ethical you want? Is it green you want? Identify what the correct criteria is. And then you go through the same kind of risk appraisal process as I was talking about earlier. It's just with slightly different assets.
Okay, well, many thanks for that, Paul. Very helpful. And just to bring in Tom McPhail from Farrer & Co. Good afternoon, Tom.
Good afternoon. Thanks for having me.
So you specialise in dealing with disputes and litigation. We've been in this unprecedented time over the last 12 months. How have you seen, has COVID increased the number of private wealth disputes you've seen, pressure on trustees, or the opposite? Have we seen more unity because people are banding together in these times of trouble? What's been your observations?
Well, I mean, I'd be interested to hear from those attending what their experience has been. I think in terms of what we've seen, I don't think we've necessarily seen a significant increase in full-blown private wealth disputes, but what I think we have seen is an increase in people seeking advice on a whole range of trust-related matters. Now, I think that's understandable. On one hand, if people are living more confined lives and to put it bluntly, they're not able to do fun stuff, then it's natural to think, well, I might as well do some admin. But I think probably more seriously, the pandemic, I think, has confronted people simultaneously with mortality and with great uncertainty. And I think it's natural in that context for people to want to try to regain a measure of that certainty by putting their affairs in order. So that's certainly something we have seen.
Okay, thanks. And I mean, Dawn mentioned one of the things that trustees need to be on top of is where beneficiaries are resident. Situations where people live has changed during this period. What are some of the risks from that area for trustees?
Yeah, well, I'd agree with that. And I think actually Paul's comments on foreign non-grantor trusts highlighted that very clearly. Tax is certainly one thing that springs to mind, and the potential impact of changes of residence is something I think that trustees and beneficiaries should always be alive to. I mean, for instance, a move to a civil law jurisdiction might raise issues because if, for instance, a settlor who's also a beneficiary of a trust moves to a civil law jurisdiction, then if they die, then it may well be that that jurisdiction for tax purposes treats the assets of the trust as forming part of their estate. So I think I know Charles mentioned governance earlier. I think it does highlight the need for good communication between trustees and beneficiaries. And I think there is a job that trustees can do to help beneficiaries to keep these kinds of issues at the forefront of their mind. And if a beneficiary is planning a move, to talk it through with them, perhaps take some local law advice as well.
Okay, thanks. And if during this period of downtime, the client has decided to change trustees because the structure they had weren't working for them, what do you observe of people changing trustees and issues that can arise off the back of that?
Well, I mean, it can cause issues. I mean, I think the first thing to say is that, of course, there are all sorts of reasons why you might want to change trustee, and it's certainly not the case that all or even most of these cause problems. I mean, you certainly, on the other hand, can imagine situations where looking to change a trustee might be problematic. If to take an example, you have a settlor who is a beneficiary and wants the trust fund appointed out to them and runs into opposition or resistance from a trustee. And if they wish to remove the trustee in the hope that they might be able to replace them if they have reserved powers to do that with someone more amenable, then that's clearly a problematic situation. So it is something that can cause issues if it's not done in the right way.
And how should trustees look at the issue of reserved powers?
Well, I do think it's an issue which has become increasingly relevant for trustees, and one I think that they should perhaps focus on somewhat more when taking on a trusteeship, in particular because one development we've seen over the past few years is that the courts have become increasingly willing, I think, to assist creditors or perhaps spouses to access assets that are held in trust if the court is convinced that there are grounds for doing so. And we've seen that in the context of attacks on the validity of trusts. And in that context, the court will consider as a matter of construction whether a valid trust has been created, and reserved powers can certainly be a central element of that consideration.
Okay, they're more commonly used in jurisdictions where the tax code doesn't prevent that, the trust from becoming taxable, like in the Middle East, for example. Is that often the context in which you see reserve powers coming in, or more broadly?
I mean, I think that's certainly right. I think it's a question for trust drafts people as well, that you want to be alive to the extent of any reserved powers, and to make sure that they are not so extensive as to cause problems. And certainly there's been recent authority on that and when that can cause a problem. Okay,
thanks. And finally, are there any recent cases trustees should be aware of, just bits of insight that are relevant for people on the call?
Yes, well, I mean, since we've been talking about reserved powers, I think one case for trustees to be aware of is Webb and Webb, which was a decision last year of the Privy Council on appeal from the Court of Appeal of the Cook Islands. And there, Mr. Webb had set up a trust, and he had appointed himself trustee. He was also a beneficiary alongside his son, Sebastian, and the broader context was that he was divorcing, and Mrs. Webb was seeking matrimonial property orders. And there the court looked at the construction of the trustees and found, along similar lines to those in the Pugachev case, which I'm sure many people will be familiar with, that those powers were too extensive. And actually, I think it's a particularly useful case for trustees because it provides what you might think of as a sort of thought experiment for trustees to perform, because the court established a test to say, look, the way to look at this is to say, are the reserved powers so extensive that the settlor has an uncontrolled right to recover the trust property? And if they are, then no valid trust will exist. So in Webb and Webb, Mr. Webb had reserved to himself as settlor, and that was important because the power was held in that capacity. He didn't owe fiduciary duties in its exercise, but he held a power which allowed him to recover the trust property by replacing the beneficial class with himself, if he wanted to, which would have meant that he was settlor, trustee, and the sole beneficiary, and that, the court said, crossed the line.
Okay, well, thank you for that. What we're going to do now is we're going to flip off our YouTube